Zach. So here we are. Let's go back to November of last year. We had Chris Whalen, CPA, on, and we were talking about what could be with the Trump tax plan, all the different things that are being discussed. And I said, Chris, when we get into 2018, we're going to get you back in here. And you know, we should have asked him to call in today. Why didn't we think of that? Zach, you know what? Is that the phone? Let me grab this call real quick. Good morning. This is David Crossan on the lighter side of finance.
David Crossan, it's Chris Whalen, CPA. I did have the feeling that I needed to call you this morning. Was I right?
Oh, my goodness. Look at that. This doesn't look like it was rehearsed. Wow, it's amazing you called in just at the right time. Chris, thank you so much for calling in, and this is a perfect time. We had you come in, I want to say it was November of last year, to talk about the possibilities of different changes and different things that could take place with the Trump tax plan. Now we're into 2018, and now we have some clarity. And before we get going, I want you to do me a favor, because we're going to talk about different scenarios where still, even with the limitations, buying a home still makes sense. And on your website, you have different examples of that, different case studies. Would you kindly give your website out to everybody if anybody wants to look at it while we're on the show today?
Sure. Just go to chriswhalencpa.com, and you'll see in my header there's a memos page. Click on the memos page, and we're going to be talking about, during our time together, case study number 1 and number 4. I purposely put them near the top of that page. So if you want to follow along with actually the spreadsheet that I created, you could do that there.
Chris, this is perfect because you and I have been speaking about this for a while with certain limitations on deductions when it comes to mortgage interest, state and real estate taxes, different things that were deductible, but there's some limitations. So you took the time, you and I spoke about this, where it still makes sense. It still is a good idea to purchase a home and the deductions that you have. Can you get into the 2 case studies that you referenced before?
Sure. First, right, I've worked on many scenarios, probably 20 so far, where I really haven't seen any where there's a negative impact on the new law with people who currently own or would like to buy. So that's very positive. I try to dispel. There's a lot of hysteria out there as if, this is terrible, it's going to hurt the real estate market, and I don't see that directly from a tax analysis perspective. So the first case study I wanted to talk about was a family making $100,000 a year, and in 2017 they rented. They were renters, so they didn't have any itemized deductions, and they simply took the standard deduction and their personal exemption. So in our example, we have $100,000 income basically. The standard deduction is $12,700, which comes off of that income, and personal exemptions of $16,200, which also reduces taxable income. So in this example, if you're following along, you'll see that we have taxable income of $71,100. All right, so that gives us a tax of $9,736. So that's their renting, and that was 2017 law. Now let's take that exact same scenario, a financial scenario, and put it into 2018, and we're going to do it 2 ways in 2018. The first, as if they continued to rent, and the second, if they were to buy a house, and with some common itemized deductions, what would their net tax be? So in the first case for 2018, we have the same scenario, $100,000. Now the standard deduction for a married couple, has gone up to $24,000 from $12,700. Now you would think that sounds fantastic. We're going to get a really great break on our taxable income there. But they've eliminated the personal exemptions portion totally. So that's 0 in this case. So actually now our taxable income in 2018 is a little bit higher. Our taxable income as a renter is $76,000, which is $100,000 less than 24. But even though our taxable income is higher, our tax is actually lower. Our tax is $8,739 in my example, and that's because the rates have decreased, and also the tiers are when you get into different levels of the tax rates also is longer and higher. So we have a savings there of close to $1,000, even though our deductions are a little less. Now let's take that same family and let's go into as if they purchased a house. So they're itemizing their deductions now. They still make $100,000, and I'm going to briefly go over their deductions now. They have state taxes of, say, $3,200, property taxes of $6,800, mortgage interest of $15,000, and, say, charity of $1,500. Those are pretty standard deductions at this income range, and that gives us itemized deductions of $26,500. Now, you can take either the larger of your standard deduction, which in this case we just mentioned was $24,000, or your itemized, which is $26,500. So, of course, we'll take that, and that gives us a taxable income in this scenario as a homeowner of $73,500. So our taxes is lower than even if we were renting, down to $8,439. So even with the loss of the exemptions, for example, we still have a lower tax as a homeowner, a much lower tax than if we were to be renting in from 2017, especially 2017 over to 2018. From renter to home buyer, I'm saving about $1,300 in tax.
Chris, okay, so let me just break this down into a couple different buckets. For 2018, the state and local income tax deduction is a combined $10,000. Is that correct?
That's correct.
So it could be a situation where somebody has property taxes, I'll make this up, $6,700, and state income taxes of $4,000. So that would be $10,700. But of that, only $10,000 is what would be the deduction. Is that the best
Correct.
way to sum it up? Okay.
Yes.
Can we see, I think the confusion is, and I speak to a lot of different people about this, is they don't understand how that works. And I think that sums it up nicely. Can we shift now to the mortgage interest deduction? Because some people are thinking, well, no, isn't that for mortgage interest? That isn't the case, though. Can you go into that?
Absolutely not. There are some slight changes, but for most clients of mine, most people out there, you're still going to get a full deduction on your mortgage interest. And it has traditionally been for many years up to loans of $1 million. So if you have a $2 million mortgage and you have $10,000 in mortgage interest, you only could take $5,000. But most people don't have that much of mortgage indebtedness at all. But that was the rule. Now, in 2018, that's lower to $750,000. So you can only take mortgage interest up to that principal loan amount. If you have more, we have to prorate it based on the amount. So for example, we had $1 million of mortgage interest now, and we have $10,000 of mortgage interest. We can only take $7,500 of it because $2,500 is excluded because of lowering that cap.
All right, let's touch upon home equity interest. There's some confusion there. Has it been eliminated, or are there particular situations where you can write it off? Can you explain the differences?
To be conservative, let's say that all home equity debt, including what you had prior to 2018, very important, is not deductible. So start with that, except if it was based on home acquisition indebtedness and or improving your home. And we're still waiting for exact direction. But if you got it for a vacation, if you got it to pay off credit card debt, if you got it to finance college, finance a car, anything else, it's no longer deductible at all on your tax return. Again, so that's a tax advisor question. If only if it relates to actually acquisition indebtedness, but it's something to talk to your tax preparer about that specific deduction.
All right, so for each person in the past, they may have utilized a home equity loan for education purposes, for different items other than the purchase of a home, the acquisition of a home, or for home improvements. Now they really are looking at, hey, what are you using this money for? And in some cases, you may be able to deduct it. And in other cases, if it's not related to the home, it's not going to be able to be deducted. I think, is that a fair assessment? Again, each situation is different, but that seems to be my takeaway.
Exactly.
Big one here. I remember you and I were talking about this back in November. The unreimbursed business expenses off the table. Is that the case for 2018? Can you explain that a little bit?
Yes, it is. This is very, very significant. There are a lot of people who work as an employee. They get a W-2, but they have certain business expenses that are not reimbursed to them. Could be mileage, someone's on the road, it could be your cell phone, could be home office. A lot of times it's mileage that's high. Now, this was a very important deduction for these people as it really reduced your taxable income significantly, and it should have, because you really weren't making the money you were making, right? If I made $100,000 and I have $20,000 of unreimbursed expenses, well, I really should have $80,000 of taxable income at the end of the day, and that's basically how it worked. But they've completely eliminated all of the miscellaneous itemized deductions, and those unreimbursed business expenses are part of that. So anyone that has that, I really urge them especially to really get things analyzed to see how you're impacted. I've told people that it even would make me want to renegotiate my salary and compensation package, right? Because people that are on the road with these expenses, they make salary arrangements, and that's based on assuming what the net tax would be, right? The next net tax impact. Now, if that tax impact has changed and it's going to hurt you, well, that might mean that you need to negotiate a higher salary now because you aren't getting the benefit of taking those deductions anymore, or get your employer to reimburse you now for expenses that you're paying on behalf of the company. Does that make sense?
No, it totally makes sense. And that's a big item because for the individuals that are listening right now that, have in the past had those deductions available and now they don't, yes, talk to your employer. Maybe there's an opportunity where with their compensation, they can put money away pre-tax for that purpose. So it starts a brand new conversation. And Chris, it was great that you and I were talking about at the end of last year to kind of give people a heads up. Hey, these are things that may occur in 2018 to be prepared. And it's so funny. You and I talk about this all the time. I think a lot of people think when it comes to seeing their accountant or their CPA, they show up once a year, they give their tax documents, and they disappear. This is an ongoing thing. This is an ongoing situation where things are changing, different things that can be done during the course of the year. You and I talk about this all the time. Charitable deductions. People have a tendency to do it at the end of a year, but you were telling us that these charities need the actual money at the beginning of a year. That's when they're at a point where it's low with their funds and the different things they need to do.
Oh, yes. If you can, if you're thinking of giving, get in the holiday spirit right now. It's Christmas in January, and let's send, because I do a lot of nonprofit work, and they are, in another month or two, they're going to start getting lean again. They're going to use up all that Christmas money. They're trying to budget. So, or spread it out. If you're going to tithe, going to give to charity, well, send one check a month or one check a quarter of 25% of what you'd give, because it would really help them out. People don't realize how the summertime can be really lean, and there's staffing issues. So try to do it before the Christmas season. It's really appreciated.
One last point I wanted to bring up with you, Chris. We were talking before the show when it comes to alimony, the alimony deduction. I understand that at the end of 2018, going into 19, that's going to change.
Yes, for divorce cases that are settled after 2018, the alimony will no longer be able to be deducted by the payer, and it will no longer have to be picked up as income by the receiver. And so this is very significant because I can't go into all the detail in the time we have, but what it's going to do is it's going to possibly hurt the person receiving the money. So anyone who might be on the receiving end of the alimony, it's very important that you really look at the net, because what's going to happen is, of course, the person paying the alimony after 2018 is going to want to have a lower amount to pay because the net tax impact is always figured in. Now there is no tax impact, so they're going to need to have a lower net number to pay out. So that means that the person that's getting the alimony is going to get a lower number, but they don't have to pick it up as income. So it's just very, very important on both sides. It's going to be a very big change that we really have to look at the net, what we expect the net cash to be for someone getting the money as alimony after 2018.
Chris, before we leave, please tell everybody listening, if they need your assistance, how they can get you on the phone, as well as go back and mention that website for people to look at those case studies we were talking about earlier in the show.
Well, my phone number is 732-673-0510. You can reach out to me on my website, chriswhalencpa.com. There's a nice contact page there. You can write to me, ask me any question, or set up an appointment. And you can email me directly at chriswhalencpa@gmail.com.
Chris, that is fantastic. And Zach, we need more time on this show.
There they are, Dave.
Chris, thank you so much. As always, we're going to have you again on the show really soon because that was so important. There were many more questions I wanted to get into. Thank you, everybody, for listening. My phone number, 732-657-3089, or go to my website, www.davidcrossan.wfadv.com. Go on there, look at different articles and videos on investment and estate planning strategies. Have an amazing week, and let's talk next time. Take care.
The Lighter Side of Finance is a paid program. The views and opinions expressed in this program do not necessarily represent the views and opinions of the staff and management of this radio station or Town Square Media, LLC. The purpose of the program is to provide information only. Any financial transaction can only be recommended by a knowledgeable professional who is familiar with your financial situation. Wells Fargo Advisors, LLC is a registered broker-dealer and a separate non-bank affiliate of Wells Fargo and Company.